The night supervisor shuts off the main sorting machine and walks past the empty storage shelf. She unlocks the final category vault to count the missing inventory. Claire sits inside a glass office in Purchase, New York. She spent the last 2 years reading your daily sales data. The two of you have never met in person. The day you finally sit across from her, she pushes a single sheet of paper across the table. The printed number reads $1 billion. That page looks like a finish line. Reading the document reveals the moment the company stops belonging to you. A stranger priced your life's work and understood the business better than you ever did. None of that future exists right now. A metal pot sits on your stove. The soda tastes wrong during batch number 40. Your partner Sam shakes your hand. You both agree to a 50-50 split scratched onto a paper napkin because the table holds nothing else. That napkin holds the origin of the $1 billion. The napkin also shows the moment the ownership starts slipping away. You start level 1 in your kitchen. The very first batch fits inside a small stockpot on your own kitchen stove. The dark liquid comes out cloudy and leaves a sticky ring on the pot. The flavor tastes like your third attempt instead of the crisp recipe you wanted. You brew another batch. You repeat the process 11 more times. Batch number 40 feels like a finished product. The liquid becomes a product ready for a stranger to hold. The carbonated soda pours into empty aluminum cans. A manual seamer closes each individual aluminum can one at a time with a loud click. Your own thumbprint presses onto the wet adhesive label and leaves a slight smudge. You operate as a single person with a recipe. A person with a recipe stands behind a folding table at a Saturday market. Shoppers walk past while you sell a functional botanical soda for $4 a can. Sam handles the other half of the daily work. Sam manages the ingredient supply chain, the daily financial spreadsheets, and the long phone calls to a tiny beverage co-packer located 2 states away in Pennsylvania. One night at the kitchen table, the two of you divide a business that does not exist yet. You write the 50-50 split on a paper napkin because you lack anything else to write on. Half of zero feels like a generous gift. The agreement becomes the most valuable asset either of you will ever own. You give half of it away while eating takeout food. You learn the harsh reality of what a single can cost to produce. The carbonated liquid, the printed aluminum, the paper label, and the small freight bill to your front door cost close to 90 cents at this small production scale in your garage. You sell the can for $4. The $3.10 gap feels like pure profit. The gap is gross margin. The money sits there before rent, before advertising, before every future employee, and before the version of you that has not collected a paycheck in a year. Founders fail at this stage because they believe they get to keep that gap. A local independent grocer tastes your product at the weekend market. The store buyer asks if you can deliver 200 heavy cases by Friday afternoon. 200 heavy cardboard cases exceed your kitchen space. The next order exceeds it too. You already agree to the deal before figuring out the logistics. You reach level 2 and meet your first 1,000 customers. Accepting the deal means moving production to the co-packer. Inventory bills arrive before a single can sells. Selling fast enough to cover the debt requires stopping the wait at the market table. Finding the buyers in person becomes the only option. A basic website goes up over a single weekend. 12 cold cans pack into a recycled cardboard box for $36. Advertisements start running on the one social platform where user attention remains cheap during these years. The setup feels like pure magic for a while. Turning a stranger into a first-time buyer costs about $24. 1 in 3 of those buyers returns to purchase the soda again and again. The average customer generates around $120 in lifetime value. Spending $24 to make $120 brings the cash back to your bank account inside 2 months. Business genius has nothing to do with this result. The actual advantage is operating a machine that prints a bit more cash than you feed it. Feeding the machine everything you have becomes the only logical move. Crossing 1,000 customers happens quickly. 5,000 buyers follow soon after. A digital dashboard demands your attention the way a heart monitor demands a doctor. Every borrowed or scraped dollar goes back into the machine. The machine works. Building the whole company on the quiet assumption that the machine will work feels safe. You see a calendar date nearing. Circled for no particular reason, the date means nothing to you right now. The date marks a software update. You reach April of the year 2021. A phone inside a stranger's pocket asks them a single question. Their answer breaks the only growth engine you have. At level 3, the growth engine halts. The mobile operating system presents a mandatory pop-up asking for tracking permission. Over half the daily active users tap the decline button on their screens. Marketers lose access to past buyer purchase history, email addresses, and mobile browsing behavior. The recommendation algorithm fails to match new prospects to previous high-value customers who bought similar items in the same category. Return on advertising spend drops across all active Facebook and Instagram campaigns. Marketers used to see $3 returned for every dollar spent on Facebook ads. That vital metric drops below $2. Customer acquisition costs spike across the catalog. The price to acquire one new buyer doubles to $55. This figure climbs to new peaks every subsequent quarter as the algorithm struggles to find buyers. The fundamental unit economics fail. A direct-to-consumer company spends $55 to secure a first purchase worth $36. The business loses money the second the warehouse team prints the cardboard shipping label and packs the box. Founders gamble their entire operation on repeat purchases to recover the large deficit before payroll hits. Analytics dashboards display zero daily conversions, while the credit card processor clears customer refunds for canceled orders. Founders have no dedicated account manager to call for technical help. A default privacy setting on a consumer smartphone triggered the revenue outage without sending a warning email. Founders face a mandatory choice with painful financial consequences for the company. They can continue funding an inefficient digital advertising platform and hope the algorithm fixes itself. This path drains limited cash reserves to buy unprofitable top-line revenue growth that bankrupts the company. Alternatively, founders can admit the digital-only retail era ended and accept the new market reality. An online-only direct-to-consumer business model reached its maximum growth capacity. Sam needs to stop the daily financial losses. A sleepless week of whiteboard brainstorming produces one physical retail solution involving actual store shelves. The team abandons the Shopify digital storefront to focus on manufacturing physical goods. They pivot to physical retail shelves in independent brick-and-mortar stores. Shoppers walk through these physical grocery aisles looking for new products to put in their carts. Supermarkets pay large marketing fees and run weekly printed circulars to attract those local shoppers into the store. Sam emails a category purchasing manager at a regional natural grocery chain in the Midwest. The manager replies the following morning and grants a 15-minute introductory phone call to discuss wholesale pricing. A single operating system privacy update dismantled the digital profit model and changed the industry forever. Physical retail shelves demand steep upfront slotting fees and volume discounts compared to cheap digital advertisements. Level 4 introduces the physical retail shelf. A grocery buyer approves your product, and your founding team celebrates for a week. The accounting department processes the commercial invoices the following Monday. Physical stores collect a percentage of every sale, a cost digital advertising platforms never charge. A major supermarket chain demands 38 to 45% of the final retail price. When a shopper scans a $3.99 can at the register, the store keeps a large chunk, sending less than two-thirds of the cash back to your business. Logistics companies truck your inventory to the loading docks and deduct their own freight fees from the remaining balance. Store managers charge slotting fees to place your items on the metal racks. They demand hundreds or $1,000 per product per location. Launching across an entire region requires tens of thousands of dollars in upfront payments before a single customer buys a can. Buyers expect constant visibility once your product sits next to the competition. Your marketing team funds weekly discounts, promotional coupons, and end cap cardboard displays. These campaigns consume 15 to 25 cents of every retail dollar. Adding all these physical retail tolls reduces your original 55% digital profit margin to 25%. Selling in stores builds brand recognition instead of immediate wealth. You must burn through cash reserves to build that recognition. Founders must secure outside capital to cover these expenses. Lawyers convert the original kitchen napkin agreement into a formal corporate charter. A seed investor wires enough money to manufacture the first large batch of inventory. You and Sam surrender 20% of the business to secure that funding. A larger venture capital firm agrees to lead the next funding round. The partners refuse to schedule an introductory call until your accounting software shows a couple $1 million in revenue and a signed contract with a national retailer. The venture capitalists take another 25% of the equity during this round. Your original 50-50 ownership split vanishes. You and Sam work 80-hour weeks managing daily operations. The founders hold a shrinking percentage of the business they built. Shoppers recognize your label in the beverage aisle. Corporate competitors notice this visibility. A multinational corporation with 1,000 times your revenue spots your success. Their product development team creates a replica beverage. The corporate giant prices their copycat product below your manufacturing cost. Level 5 introduces the category. The copycat product fails to destroy your business, a fact that shocks everyone in the industry. The giant corporation successfully manufactures your beverage. They fail to replicate your core purpose. Shoppers who discovered your brand refuse to switch to a cheaper alternative for a mere 40 cents. Your company survives the imitation phase, and this survival triggers an unexpected industry-wide realization. Retailers and competitors suddenly recognize your brand as the authentic leader. Your distribution expands from a single region to a national footprint. Target stores stock your cans, followed by every major retail chain in the country. Your product eventually fills tens of thousands of store doors across the nation. Annual revenue climbs to $300 million across all retail shelves. Your sales grow at a 40% clip, while the legacy giants sitting next to you manage a measly 4% growth rate. The Its brand provides a useful comparison, generating roughly $500 million in annual revenue right before PepsiCo announced a $1.2 billion acquisition deal in 2024. Your beverage becomes the fastest-moving item in the entire aisle. Upstream distributors only care about one metric in this business, and that metric is speed. Magazine photographers never warn you about the financial reality when they take your picture for founder profiles. Your company reaches an enormous size while remaining barely profitable. Retail shelf fees drain your margins, and aggressive growth consumes your cash reserves. You become the highest revenue-generating broke person in your entire network. 3 years pass without you drawing a real salary. Last winter, your personal credit card covered the company payroll for 2 consecutive weeks. You kept this financial emergency a secret from your team, and you still memorized the exact credit card balance from that stressful period. The bank statements from that December still sit in your personal files, serving as a permanent reminder of how close the business came to collapsing. Your phone suddenly rings with calls from a very specific type of caller. Corporate development teams from massive beverage conglomerates reach out to you. These callers already keep your products in their own office refrigerators. The acquisition teams ignore your profit margins because they easily spot your lack of profitability. Instead, they ask about your growth rate and the speed at which your cans leave the retail shelves. A century-old corporation cannot manufacture rapid growth or high shelf velocity internally. Your company possesses both of those rare assets. Sam wants to raise a massive funding round and keep the company independent. He envisions building a lasting business that answers to zero outside investors. This path requires diluting your ownership again and fighting Coca-Cola-sized incumbents. Finding a new customer currently costs $55 or more. You calculate this financial math at 3 in the morning, and the numbers terrify you. You previously watched a single software update destroy a business you considered permanent. You lie awake at night remembering that failure. A woman named Claire from a major conglomerate in Purchase, New York, requests your retail scan data during a meeting. You agree to share the data before telling Sam about your decision to enter level 6. The due diligence process feels like a stranger reading your personal diary out loud. Unfamiliar accountants spend weeks dissecting every number your company ever generated. They review every contract, every label promise, and the exact production cost of every single can. These analysts understand your business operations better than you do because you spent all your time running the company. They sit in your conference room with spreadsheets open, pointing out inefficiencies you never noticed. Claire eventually slides a piece of paper across the table. The headline number reads $1 billion. Your initial reaction avoids joy. Instead, you experience the specific dizziness of watching someone price your creation without a single ounce of sentimentality. You read past the headline and discover the true meaning of a $1 billion offer from a giant corporation. The deal does not hand you $1 billion in cash. The upfront payment totals $850 million. The remaining $150 million exists as earnout money. You only collect this final portion if the brand hits specific performance targets inside their corporate structure over the next few years. This structure turns the final slice of your sale price into a corporate performance review. A quiet footnote reveals another detail. A large chunk of that $1 billion represents a tax benefit. This tax break lowers the actual cost for the acquiring company rather than increasing your payout. PepsiCo previously bought the Poppy brand for $1.95 billion. $300 million of that total represented anticipated tax benefits, cutting the real purchase price to $1.65 billion. The acquiring company uses these accounting tricks to reduce their actual cash outlay. A $1 billion valuation against $300 million in sales equals a multiple of roughly 3 times revenue. This multiple represents a strong number for a brand of your size and speed, landing right in the range that authentic breakout brands command. RXAR sold to Kellogg for $600 million on around $120 million in sales, achieving a rich multiple. Dollar Shave Club sold to Unilever for about $1 billion. Poppy sold for nearly $2 billion. Traditional consumer packaged goods brands change hands for less than half their annual sales. Breakout brands command 3 to 5 times their sales. The final valuation reflects your specific combination of speed and scale. You then complete the final piece of arithmetic regarding your personal ownership. After the seed round, the growth round, and the expansion capital, you own about 1/5 of the company. Sam owns a slightly smaller percentage. Your 1/5 of $1 billion before the government takes its share equals around $200 million. This amount exceeds the total combined historical earnings of your entire family. It also represents a fraction of the headline number on the page. Both statements remain true at the same time, and neither fact cancels out the other. Sam reads the earnout terms twice. His facial expression shifts in a way you will remember for years. His face shows a man performing the same subtraction you just completed, only he lands on a much sadder conclusion. Both of you sign the documents anyway. The pens scratch against the heavy paper, finalizing the transfer of your life's work. The wire transfer clears on a Tuesday. You experience the strangest part on Wednesday. You badge into the same building and pass the same reception desk to run the same brand. The environment now includes an employee badge, a direct manager, and a quarterly sales target belonging to someone else. You did not leave the company. You sold the business and stayed. The earnout structure forces you to keep the seat warm and hit corporate numbers to collect the final piece of your own sale price. You become an employee of the very thing you invented for the first time in a decade. The morning commute feels different when you drive to a building you no longer own. Months pass before you finally understand Claire's true identity. She's not the person who bought your company. She operates the machine that consumes companies like yours on a strict schedule. Claire read your retail scan data for 2 years before you ever spoke to her. Her equivalents at 3 other major conglomerates performed the same analysis. Reading scan data represents their actual job description. These massive corporations no longer invent new brands. Inventing a brand requires eating formulation risks, taste risks, years of unpaid labor, and the brutal rising cost of acquiring a single customer in a market that went half blind in 2021. A century-old corporation remains structurally incapable of surviving that gauntlet. The conglomerates stopped trying to build from scratch. They let thousands of founders run into that fire using their own money and personal credit cards. The corporations simply wait and buy the handful of founders who walk out alive. The conglomerate never bought your recipe from you. They also ignored your profit because your profit barely existed. They purchased your growth rate, your retail shelf position, and one critical asset you could never see from inside your kitchen. The acquiring company already owns the delivery trucks, the distributor relationships, the retail leverage, and the shelf space. Renting that shelf space by the case previously cost you 1/5 of your entire company. The moment your product entered their distribution network, the tolls strangling your margins vanished. The conglomerate operates at a scale where they refuse to pay those tolls. They set the tolls instead. Your billion-dollar brand, which previously struggled to pay you a basic salary, becomes richly profitable the instant it stops belonging to you. The gap between what your product earned in your hands and what it earns in their hands represents the entire reason the check existed. The $1 billion served as the price of you never having to discover whether your margins could survive alone. You accepted the money because you already watched permanent things break at incredible speed. The corporate lobby and purchase features a small heritage display behind a pane of glass. The second shelf sits next to logos you grew up drinking. A single cloudy can rests there, featuring a label applied slightly crooked by a thumb at a kitchen table long before any of this existed. That can represents the very first one you ever made. You kept that physical can for 10 years. The corporation now owns it too. They own the can, the recipe, the name, and the growth. The only thing in the entire building that still belongs to you remains the memory of the stove.